Anyone can become a millionaire through stock market investing. It's as simple as that, even starting with zero. Now, I stand firmly behind that statement, and I promise you that by the end of today's video, you'll see it's not as crazy as a lot of your friends will tell you. In this video, I'm going to show you all the statistics, all the data to back up exactly what I'm saying. But I'll also give you the system and the blueprint on how to do this, and I'm going to do it for free. There's no paywall to get what you will get in this video. Everything will be laid out to you on this video for free. There's nothing to buy to get that information. Now, for those of you on social media, now look, I never came from money myself. God knows I was a broke kid. I had nothing. I climbed all the way up, which I did for 10 years. I got paid well, but I was not a millionaire when I quit because of my salary. With all due respect, I was preparing myself to become financially free the day I left. Out of my own choice, on my own terms, because I spent my entire time there investing my money and being frugal and being smart with my money. By the time I left, I literally didn't need anyone. All I needed was peace of mind, some time to rest, and then this YouTube thing happened. And now I'm doing something I love, and it's a great business, so it's a win-win. And the same exact things I have done over my 10+ years investing in the stock market, you're going to find out about today. It's going to be free. There's no sign up, there's no payments. So trust me, by the end of this video, you're going to have everything. But please, could you click the subscribe button and smash the like button? Don't buy nothing. Just pay attention and enjoy. Listen, now, the standard advice for stock market investors, especially beginners, is to invest a lot of money in the S&P 500 because that index is unbeatable. Studies show that about 90% of funds lose to the S&P 500 if you give it 15 to 20 years. The longer you go in the S&P 500, the more and more it becomes undefeated against professional money managers. So the standard system would be something along these lines. Put $50,000 in the stock market, put it in the S&P 500, add in another $800 a month, give it 20 years, and there you go, you have $1 million, right? And that works. In fact, that's going to outperform most professional money managers. But if that's the case, why don't we just have 100% portfolio in the S&P 500? Why do you tell them? Well, you have 60% of your portfolio not in the S&P 500, actually, you have it in stocks. Well, for one reason and one reason only, funds lose to the S&P 500 because they cannot play the game I'm about to teach you. They just literally cannot. Funds have to deliver quarterly and annual results. They have to provide results every quarter, every year. They gotta be active, they gotta trade. And the other thing is, they cannot be concentrated. They have limits to how much of a stock they can hold, while in my portfolio, for example, I have 40% of my entire portfolio in one single stock, which is unheard of. It's unthinkable. It's insane. And yet, that stock gave me 400% over the past 18 months, and I'm not about to sell it anytime soon. But that's beside the point. The thing is, we, as long-term individual investors, are investing our own money. We are not answering to anybody except our wives, but that's a whole different story. We, as retail investors, simply don't have to deliver results every quarter or every year. We can stomach a lot of bad years because at the end of the day, we can play the long-term game. We can be highly concentrated and go for the biggest winners, which they can't. It's as simple as that. We can focus on the best companies, the best 2, 3, 4, 5 companies in the business, and we can stay in for 20 years and live with a bad 3 or 4 year stretch here and there. These funds, they simply cannot. And the prime example is, again, Palantir. Palantir launches at $10 per share. Everybody gets hyped about the stock in 2021. Stock runs up to $40 per share. Then the balloon pops, stock drops below $7, and now the stock is back at $40 per share about 2 years later. What did the funds do in that period? They cut their losses. If they invested at 35 and the stock dropped to 7, they're not staying in. For the most part, they're cutting their losses. They're living to fight another day. And the thing is, it's not just Palantir. It's way more common than you think. I'll show you in a second, it's not that rare. Most statistics that basically tell you, well, 90% of retail investors lose money, that is true, but they're talking about traders. With traders, the top 10% actually outperform the bottom 10% by 130% per year. That is wild. That is insane. Basically, for traders, unless you're in the top 10%, you're not making any money. You're losing huge amounts of money. But for long-term investors, that skill gap is a lot closer. In fact, the top 10% only outperforms the bottom 10% by about 9% per year. That's the whole difference. So even the lower tiers 2, 3, 4, they still make money. In fact, I haven't said tier 4 by accident. 40% on average of retail investors that play long-term investing actually overperform the market and 60% underperform. And about 30% of the bottom, they really get hammered. They lose a lot of money. But for the most part, your chances of hitting that 40%, all you have to do is be above average, and you will overperform the stock market if you play the long-term stock investing system I'm about to show you in this video. The only problem is the difference between being in the 60% group, which is the bottom, and the 40% group, which is the top, is actually razor thin. Now it's pretty much like basketball if you think about it. Like Steph Curry, one of the best three-point shooters in the history of the NBA, shoots about 43% from the three-point range per year. That's his career statistics. The worst point guard in the NBA, they shoot about 35%. So the whole difference between Steph Curry and the worst point guard in the league is about 8%. That's a very thin margin. And it's the same with stock market investing. The differences are minuscule, which means two things. Number one, details matter, and number two, the longer you play, the more your advantages are being brought forward. What do I mean by that? Well, think about it this way. If you have a razor-thin advantage, the more games you play, the better your odds are of winning. And the fewer games you play, well, there's more chances of you being a loser. Do you mean, Mike? Well, from 1928 until today, we have 54% of green days and 46% of red days in the market. It's pretty much a coin toss on the daily. That's like casino numbers. But guess what? The casino doesn't need more than 2, 3, 4% of an advantage to make a whole lot of money. Why? Because of repetition. They play longer, they play more games, more repetition, and that advantage becomes 100%. Don't believe me? Well, check this out. If you have a 54 to 46% advantage on the daily, if you play the whole month, that advantage grows to 62%. If you play the whole year, that advantage grows to 75%. And if you play 10 years, that is a 100% chance of you winning. That is insane. This literally shows you that if you stay in the market, you will not lose money as long as you've stayed 10 years or more. A lot of people look at this market and say, well, Mike, we have such a high PE right now, price/earnings. The market is overbought, it's so expensive, and maybe it is. But on a 10-year period, the longer you stay, 10, 15 years, that PE ratio becomes literally irrelevant. Simple as that. Warren Buffett has said it, I think, the best. Everyone wants to get rich. Nobody's willing to get rich slow. When you hear that 10, 15-year thing, you all get the heebie-jeebies because you think that's some sort of a curse. That's how you make the money, and you don't have any idea how important that stay in the market statement is. If you just missed out on the top 10 days in a 20-year period, your returns will be slashed by 50%. And I know a lot of the smartasses in the comments are gonna say, well, Mike, what if we missed the worst 10 days in the market over 20 years? Yeah, of course. But can you deliver me a system that guarantees that I will miss the worst 10 days, the worst 20 days? Is there a system that I can time the market perfectly and miss those days? No, it's theoretical. But if you stay in the market, you are guaranteeing by 100% you're not gonna miss out on the best 10 days. As simple as that. The trick is very simple. Buy big chunks of the S&P 500, that is step one. But that is not the end of the story. This video isn't about just buying the index and sitting in it. That would be a solid strategy for any investor. But my system is way, way, way better. Now, how is it so much better, Mike? Well, because you have some extra things you add on top of it to build on that foundation. If your foundation is 30, 40, 50% in the S&P 500, what do you do with the rest? That's the big question. Well, the rest is very important. What you do is you look at what other rich people are doing. And if you look at what the million-dollar portfolios are doing, according to Vanguard, you're going to find out that they're doing very similar things to what I've been preaching for the past 4 years. Number one, they only trade about 8% of their portfolio in any given year. Number two, they're 82% US focused, which means they only invest in US stocks. Number three, they do not panic sell, which means in the time of crisis when there is blood on the streets, they do not sell, they stay in the market. In fact, in the pandemic, according to that Vanguard study, 99% of them have not sold out of the market when everybody was running around like headless chickens, taking oil to negative prices. Now, if you pick good stocks and you add on top of it the S&P 500, what do you do next? Well, here's the thing. The one thing that they have not been telling you about smart long-term investing is not just staying in the game. It's not just high conviction. It's actually going against the trend. Studies show that smart investors, the ones that classify in that 40% range and even in that 20% range, they do not follow trends. In fact, they actually invest against the trend. If everybody's buying up a stock right now, they're not there. But if everybody's selling off a stock because of bad sentiment, they're buying. And it doesn't mean that you automatically buy a stock because it went down or not buy a stock because it keeps going up. That's not the point. The point is there is a system here to be learned, and that system is very, very simple. You allocate your assets in the following manner. Big chunk to the S&P 500, big chunk to 1, 2, 3, 4, 5 companies which are your winners, companies that you have researched and you have decided, I can have convictions about these companies for the next 15 years. I'm not going to be phased. What you do next is the same thing we have done with Palantir. When Palantir went from $40 to $7 in 2022, we bought it like crazy. We bought the dip like insane people. And now that it is at $40, that cost basis is very sweet. But that happens again and again. It's very, very cyclical. Anyone can do this. The system is quite simple, and I'm going to give it away right now. There's no secrets in the video. There's no paywall. The system is this. You look at the stocks you're investing in. Let's say Palantir, Tesla, and the S&P 500 like I have in my portfolio, and you look at what was the highest price in the past year for that stock or for that index. And anytime that stock or that index drops 20% or below that 52-week high price, then you double down. And as long as it doesn't drop below that price, then you just constantly buy it every single week, every single month like clockwork, absolutely ignoring, only doubling down when it drops. Let's say you spend $100 per week allocating to each stock and the index. And let's say that one stock is currently below the 52-week high by 20%, and the rest are at all-time highs. That means you invest 100 in the all-time highs, but that one stock that dropped below the 52-week high instead of 100, you invest 200. And you keep doing that until the stock price does not climb back up into 20% below the 52-week high. It's as simple as that. Works the same for the index, works the same for stocks, no difference. Now, the thing about this is, all you have to do here is overcome that dopamine rush of actively trading stocks. Oh my God, I have to trade, that dopamine rush, that's a lie. You have to cut media out. Mainstream media is driving you for emotional decision-making. They feed you euphoria and FOMO when the market is good, and they feed you fear and basically fear porn, I'm sorry to say that, when times are bad. All they do is make you emotional because that's how they make money off of clicks and attention. And the big boys, the sharks, they take advantage of that, and they trade around you. All you have to do is overcome that dopamine rush, simple as that. Pick good companies, pick the S&P 500 dollar cost average every month, double down into weakness, stay in that system for 20 years. You have a 100% success rate as long as you've picked good companies. And the cool part about this is that the only thing you have to master in the system is one skill, which is picking good companies. Not timing the market, not what Jerome Powell has said, not when the next stock market crash is happening. Only pick good companies, that is it. The rest of it is easy, which is how to pick those great companies. No, I didn't. If you go to my last video, which I'm going to put on the screen right here, it's literally given away for free. So the entire system is basically there. But if you are a casual long-term investor, check out the rest of my videos. Go watch the previous video, it's on the screen right now. Check it out, learn from it, implement, keep watching these free videos. It's all I got for you. Hit that like and subscribe button.